Hi guys, so in today's video we'll be looking into monetary policy tools. So we'll start first. Monetary tool is OMO or open market operations. So an open market operation is an instrument which involves buying or selling of securities like government bonds from or to the public and private banks. Okay. The RBI sells government securities to control the flow of credit and buys government securities to increase the credit flow. Okay. The central bank that creates money. Then central bank purchases government debt from financial institutions. Okay. Then what happens? The interest rates decline. So what happened once the interest rate of loans decreases? What happens? The businesses and consumers they will borrow more. So business and consumers spend more and stimulate the economy. Okay, that is an example of open market operation. Okay, now second one is cash reserve ratio or CRR. We often have many doubts about what is CRR, SLR, all these points. Okay, all these points will be covered in this lecture. Okay, cash reserve ratio is a specified amount of bank deposits which banks are required to keep with RBI in the form of reserves or balances. The higher the CRR with the RBI, the lower will be the liquidity. Suppose what happens? The CRR rate is 4% and the depositor will deposit 1,000 rupees with the bank. What happens? With CRR rate at 4%, 40 rupees should be kept with RBI. What if the CRR rate is above 50% or something? What happens at that time? 500 rupees will go to the RBI and the balance with the bank will be 500. So it will be very less amount will be available by the bank to give out as loan. Okay. Now, statutory liquidity ratio or SLR. Okay. All financial institutions have to maintain a certain quantity of liquid assets with themselves at a point of time of their total time and demand liabilities. This is known as statutory liquidity ratio. The assets are kept in non-cash forms. This is a very important point. Non-cash forms such as precious metals, bonds, etc. Okay, as of 2019, it stands at 18.25 percentage SLR. Okay, so companies and general public deposit money in the bank, and of the total amount, 18.5 percentage is taken as SLR and kept by the bank in the form of non-cash liquid bonds and government securities and all. Okay. Now, bank rate policy. What is bank rate policy? It is also known as discount rate. Bank rates are the interest charged by the RBI. It is charged by the RBI for providing funds and loans to the banking system. Okay. An increase in the bank rate increases the cost of borrowing by the commercial banks, which results in the reduction in the credit volume to the banks. Hence, the supply of money declines. Okay. And an increase in the bank rate is a symbol of tightening the RBI monetary policy. So we know that banks they give out loans to the general public. Just like that, the banks take loan from RBI. So central bank is there. Okay, central bank is there. So at bank rate, that is the interest rate charged by the central bank on private banks. Okay, they give loans to private sector banks and public sector banks at bank rate, which is a interest rate. Okay, and when the private sector banks they give out money to the reserve bank, then that interest rate is called repo rate. Okay, now credit ceiling. So credit ceiling, it is with this instrument RBI issues prior information or direction that loans to the commercial bank will be given up to a certain limit. In this case, a commercial bank will be tight in advancing loan to the public. They will allocate loans to the limited sectors. A few examples of credit ceiling are agriculture sector advances and priority sector lending. So priority sector lending is that the banks need to focus more on poor sections of the society or say underdeveloped areas. So certain amount of loan, certain percentage of the total loans given should be given to the priority sector areas. So that is credit ceiling, that much percentage. Okay, credit ceiling. So we will see the relationship of various policies. So first one is various instruments. So if CRR or SLR or repo rates are cut, what happens? There is rise in money supply and growth and liquidity will be there, purchasing power will increase. At the same time, if deposit rates and landing rates and loan rates also fall, the same scenario will happen. Okay, so I hope today's lecture was productive for you guys. So until next time we meet again, God bless you all. Jai Hind.